If you've been earning a decent rate of interest on your savings over the last year or two, and you've been able to build up a decent savings pot, then there's obviously an increased chance that you're going to go over some of the different tax-free allowances when it comes to interest. Now, I've covered those in a separate video, including some of the ways you might be able to avoid paying tax on any of your interest. But if you have exceeded any of those different allowances that are out there, broadly speaking, that's £1,000 or £500 for the personal savings allowance, depending on your tax bracket you're in. Potentially, if you're a low earner, there's also the starting rate of savings that can increase that a lot more as well. And also, there's ISAs and premium bonds, things like that. But it's assuming that you've watched that other video and for whatever reason, you've gone over those tax-free allowances. How do you actually then pay that tax? How do you actually make sure that HMRC know how much interest that you've earned so they can calculate and tell you what you owe and then actually make that payment? Well, this video will take you through what to do. Now, there are two different methods for letting HMRC know exactly how much interest you earn from your different savings accounts. And it all comes down to whether you already fill in a self-assessment tax return or not. Now, when you are required to fill in a self-assessment tax return, it's because you have additional income that needs to be reported. So that could be dividends, it could be a huge number of investment income that's coming in, capital gains, any of those kind of things. Often when they require you to fill in a self-assessment return. But for most people, you don't need to bother. You just have your money from your job or your pension coming in as income every single month or however it is you're paid. And that's all just sorted for you. PAYE is what they call it when you get paid from work, pay as you earn. And it's much, much simpler. So if you don't already fill in a self-assessment tax return and your total income from savings and investments is less than £10,000 a year, then you don't need to do anything. You don't need to let HMRC know how much interest you've earned because the banks will tell them themselves. They send through something called the BBSI return, the Banks and Building Societies Interest Return. And that is essentially all the information about the accounts you've had and how much interest you earn in the financial year. Remember, that runs from April the 6th to April the 5th. That's the period we're looking at when it comes to those allowances, those tax-free allowances, and then any tax that's going to be due on them. They'll send that across, and there's a lot of information they'll send there. They'll let HMRC know that if it was a joint account, because remember, if you have a joint savings account, the interest is split by the number of people who have that account. So assuming there's two of you, let's say you earn £1,000 in interest on this joint savings account, well, that's £500 each that will be reported to HMRC. They'll also report interest you earn from ISAs. And although ISAs are obviously tax-free, the interest you earn on them is tax-free. If by chance you went over the annual £20,000 allowance of how much you could pay into an ISA, then they would report the interest you'd earn on the money above that until that was kind of sorted out. Or likewise, if potentially the rules right now, this is going to change from April 2024, but the rules right now are you can only add new money into one of each type of ISA. So if you put new money into two different cash ISAs in a financial year, then that would be reported. HMRC would see that and they'd know, well, actually, you couldn't have done that. Therefore, the interest you've earned on that second account or that extra money there again, that will go towards those other allowances and potentially be subject to tax. All that information is going to be sent through to HMRC. Now, again, the financial year, again, this runs again to April the 5th. The banks have until the end of June to submit that return. So there's going to be a couple of months before HMRC get this information. You can, if you wish, send it yourself, send it earlier on. I don't really see the point of doing that because, unless you've literally got just a single account and you can quickly see all the interest you earn from that single account, it can take you a fair amount of time, particularly if you are following the updates I give on the channel every single month for the best savings accounts, or go to becleveryourcash.com/savings for all those best buys, all the rates as they change. And maybe you've got a regular saver, an easy access, a fix, all these different things. Then it's going to be a bit more fiddly for you to get that information together. So I think just wait, let them report it. And then you've got another couple of months for HMRC to do their calculations and work out what it is that you owe. Now, when HMRC has figured this out, the key way that they're going to get that money back from you if you are due any tax, if you have underpaid tax on your interest, is they're going to change your tax code. Now, your tax code, you'll be able to find this by looking on your payslip or logging into your government gateway account. I've got a whole article about what I'm talking about right now over on the website, and I'll link to that in the notes. And within that, I've got some links to take you through to the relevant HMRC pages as well, so check this info. But you can see it on there as well, and you'll be able to see what it was and what it's changed to as well next to each other, so you can make that comparison. Now, for most people, that tax code is going to be 1257L, and this basically stands for how much you can earn in a year tax-free across all of your earnings, your personal allowance. That's different to your personal savings allowance, your personal allowance. And for most people, that's £12,570 a year, hence 1257. The L, again, that's going to be for most of us standardized, but there are some reasons that letter might change. There might be reasons that number has already changed. Perhaps you claim the marriage tax allowance and things like that. So again, broadly speaking, they will change your tax code to cater for that additional interest that you owe. And that would be reflecting in maybe a relatively small amount less money in your payslip as the year goes on. Now, obviously, if you have a lot more interest that is due tax, then that difference is going to be a lot bigger, and you might see a rather more substantial difference to your payslip every single month. That's primarily how you are going to let HMRC know your interest for the year and how they are going to get that money back. Now, there is an option if you'd rather not have your tax code changed, but you can make that payment in advance. Now, getting hold of HMRC is not going to be the easiest thing necessarily all the time. There are a couple of options. You can phone them or you can write to them in order for this to happen. Again, if you want to do that, then give that a try, see how you go, or just let it go and let the tax return, tax code be changed to take that money every single year. Now, if you do already fill in a tax return, then things are going to be slightly different because you're going to enter the interest that you earn on your self-assessment form. Now, remember, a self-assessment form, your deadline to do this is the end of the January following the financial year that had finished, which can potentially mean, so the financial year finishes, as we established, on April the 5th. That means you've got until January the 31st the following year. So 10 months later is your deadline to submit your tax return, your self-assessment return. I would do it earlier. I wouldn't leave it that long. But obviously you can't do it straight away as soon as the tax year ends. Well, you can, but then you go back to that same problem before of you having to go through your different savings accounts and tot up all the interest that you've earned in that time. It's better to wait for the banks to send you a savings interest certificate. They should, if you send it in the post, if it's the postal account, more often than not now it's in your online bank and you can go in and find it in the documentations. Sometimes with the different banking apps, it's just there as a standalone feature in documents that you can kind of pull that one up. If you don't have it, they haven't sent it to you, then you can request it. And that will be, this is how much interest that you earn in that year. And those are the figures that you're going to put into your self-assessment tax return. Now, if you're already filling in that self-assessment tax return, that means you've got other income that needs to be taxed as well. So this will come together in a whole big picture, and then you have a tax bill to pay. And that's generally how you are going to pay the any tax that's due on your interest is with all the other tax that you owe. Now, I do want to quickly cover here in a little bit more detail what interest you need to declare when you are filling in that self-assessment return. For a start, you do not need to declare ISAs, premium bonds, any sort of interest or winnings you get from those. They do not count. It's all the other accounts, okay? And you should declare it, all of it, even if you are under the personal savings allowance limits. You should declare it all. They will calculate whether there's any tax due on it or not. Now, for most accounts, this is pretty simple. If you have an easy access account or any account that when it pays you every single month, you can access the cash, you could actually get your hands on that money, it counts towards that financial year. So let's say your interest is paid May, June, July, August, September, every single month. It all counts. You have 12 of those different payments of interest in that financial year, and they're the ones you would declare. However, some accounts won't pay you monthly. They'll pay you potentially every 12 months. And those ones, that will count when the money reaches your account and also when you can access it. Because although the bulk of those anniversary ones that pay in a year, you can access that money as soon as it reaches your account. Some of them might pay it annually, but you might not be able to access it until the whole account matures. This is generally going to be something with a longer fix of 18 months or above. So even though it might be in your account every single month or in your account every single year, if you can't actually access the account and use it, it doesn't count for this financial year. It would all count combined together for the year where it is accessible, again, generally when it matures. So just be really careful there that you don't over-report your interest because otherwise it's going to be a bit of a mess as well in there. So that's really, really important thing to remember there. Again, as I said, wait for those certificates to come through is probably the easiest option when you are doing this. There's one last thing quickly to tell you about here, and that is once HMRC knows how much interest you've earned in a financial year, it uses that information to estimate how much interest you're going to earn in the next year. Now, for some people, that might be roughly the same, but for most of us, that isn't going to happen because, well, we've already seen rates probably peak. So fixed rates are already much, much lower than they were in 2023. And if we do see some base rate cuts in 2024, then the likelihood is that those easy access accounts, those interest rates will start to fall as well. The result of that is going to be, well, we earn less interest next year than we have this year. Also, what if you've been saving up? What if you've been saving for a wedding or a car or a home or whatever it might be? Well, you had that money in your account, earning these really high rates of interest, potentially taking you over the personal savings allowances and whatnot. But then you spend that money, your balance goes back down to something pretty low. So it doesn't matter what the interest rates are, you're not going to be earning the same amount of interest. But your tax return will still have been changed based on the interest you earned when you did have that money at those higher rates. Or maybe those fixed rate accounts we spoke about. Maybe previously you had money in easy access, but you've taken advantage recently and locked that money away and you're not going to get it for a year, 2 years, 3 years, 4 years. Well, again, that means next year your interest is going to be a lot lower because your money's locked away, but your tax code had already been adjusted based on that return or that you'd previously made, or the money, the information that we'd already sent through from the banks to HMRC. So it's worth being aware of this and keeping an eye on your tax code, as we mentioned before, just to see how it is changed when these things happen. If you feel that that tax code has been changed incorrectly because you know you're going to earn less interest, you can ask them to change it to reflect how your interest is going to be lower. And if you don't realize this and you realize in a year's time or whatever it is that you overpaid your tax, you pay more tax than you should have done because you did earn less interest, then you can get in touch with HMRC and ask them to process a refund on this. If you do nothing at all, it will even out because obviously then they can change your tax code the other way. But it's just worth bearing that in mind that this could happen to you. My name is Andy Webb. Thank you so much for watching. Check out these videos right here for more information on tax on savings interest.